All right, so chapter 12 is all about state and local taxes. All right, so let's talk about state and local taxes. All right, so this first slide, the purpose of taxes, we know what the purpose of taxes are. It's to raise revenue. We got to finance state governments just like you have to finance the federal government, okay? A couple of definitions that are very, very important. Commercial, helps to turn the pen on, doesn't it? Commercial domicile, okay? This is the state where a business is headquartered and from which it directs its operations. All right, so it's a pretty simplistic definition. All right, nexus is equally, if not more important. And nexus is defined as what is the minimum, right, connection between a business and a state that subjects that business to the state's tax system. All right, so we define nexus pretty simply and very compactly and very concise. But in reality, nexus is a pretty gray area overall, and the definition of what constitutes nexus, not the definition of nexus, but what constitutes nexus, has changed a lot with online sales in particular. But that's a topic for a different day. All right, so sales tax. All right, we've got all of these great things on this slide. You guys can read your own slide. But a couple of things that you should know: businesses that establish sales tax nexus, right, with a state, but fail to collect sales tax, they create a significant liability, all right, and it's going to need to be disclosed for financial reporting purposes. So state taxes are also a significant issue, okay? So sellers with sales tax nexus must collect and remit sales tax to their state government. If a seller doesn't have sales tax nexus, then the customer is responsible for paying a use tax to the state in which the property is used. Okay, so that's then the customer portion of that, and we're all becoming more familiar with that again through the online sales issues. Okay. All right, so we got a couple of examples here. So we've got this Kay Bailey Corporation. It's a Texas corporation, and they're engaged in the business of selling rare books. The only activity that this corporation has in New Mexico is the solicitation, of sales through representatives who visit New Mexico to sell the company's products. So the question is, does this corporation have New Mexico sales tax nexus? And the answer is yes. Okay. They have sales tax nexus because they have a physical presence. And how do they have a physical presence? Well, they have these representatives, right, who visit New Mexico. All right. Next example. We've got Perry Corporation. Okay. They're again a Texas corporation. They sell fly fishing equipment. Their only activity is the solicitation of orders for their sporting goods equipment through catalogs and flyers. They deliver the sporting goods equipment via United Postal Service to its customers. Do they have Colorado sales tax nexus? So, no, they do not have physical presence nor sales tax nexus. And so they're not required to collect Colorado sales tax because they don't have physical presence in Colorado. And they deliver via a common carrier. So they don't have their own delivery people. They're using a large common carrier. Okay. It is important to realize, though, that this world is changing. 5 years ago, they would not have had nexus, no way, no how. Currently, they can establish economic sales nexus, all right, if they meet a sales threshold. And right now, as a result of the Wayfair decision, that economic nexus threshold is $100,000 in sales or 200 sales transactions So if they were to have 200 sales transactions with Colorado customers throughout the year, then they would be determined to have nexus in Colorado. So you see the definition of nexus itself as a concept has not changed, but what constitutes nexus is evolving for sure. All right, income taxes. So again, we have this commercial domicile. So they must pay income tax in their state of commercial domicile. All right. And the Supreme Court has spelled out 4 criteria for determining whether states can tax non-domiciliary companies and to what extent. Okay. So you've got these 4 criteria for determining whether non-domiciliary companies can be taxed. All right, so income tax nexus. All right, so businesses must file income tax returns in states where they have nexus. All right. The rules for determining income tax nexus are not necessarily the same as those for determining sales and use tax nexus. All right, so it's very important. And then again, sellers of tangible personal property may be protected from income tax nexus by this public law. Okay, you are not going to need to know the requirements of the public law, but I'll quickly go through some of the carve-outs. Okay, so businesses, according to this public law, 86-272, businesses are protected from an income tax liability if all of the following apply. All right, tax is based on net income, taxpayer only sells tangible personal property, taxpayers' in-state activities are limited to solicitation of sales, the taxpayer is participating in interstate commerce, the taxpayer is non-domiciliary, the taxpayer approves orders outside of the state, and the taxpayer delivers goods from outside of the state. So you can see where that is going, right? That those types of things could eliminate income tax nexus for you. Again, you will not be required to memorize all of those. All right. And so then if we're talking about solicitation within a state, okay, and creating income tax liability, all right, the Supreme Court has upheld that the following activities do not, okay, meet the definition of solicitation, okay? And so then they would create an income tax liability within the state, all right? If these activities take place, I want to make sure that's clear. Those things would not qualify, as solicitation and would create income tax liability within the state. Okay. All right, so now we have another example. So I'll give you a minute to read this rather long explanation. All right, so the question is, does Mark have Utah income tax liability? All right, and so you can read all of these things, but I'm going to pull out some of the important pieces, okay? So we know this is a Colorado corporation, okay? And they engage in the sale and distribution of copiers and fax machines across several states, okay? He also has a copy center design team, and they provide comprehensive services to large clients. Okay, so They sell copiers in Utah through a local sales force. That means folks in Utah. They maintain no public sales office and maintain no inventory in Utah. Okay. All orders are approved in Colorado and delivered via common carrier. All right. But to be competitive, he also has sales agents on site to supervise installation and perform a 2-day seminar on the proper use of the equipment. So, does Mark have Utah income tax liability? And the answer is yes. Okay, so he ships via a common carrier, and all of the orders are approved out of state. However, the installation and the training services, right, that are provided by the sales personnel, these are not determined to be solicitation. Okay, so these are not ancillary, they're not de minimis, these are real valuable services. They allow him to be competitive. So yes, he is going to have income tax liability in Utah. All right, what about this? So take a minute, look at the slide. All right, so now we're talking about Arizona, all right? And Mark Corporation sells copiers in Arizona. Again, all orders are approved in Colorado. They're delivered via common carrier. So Mark has reduced his normal fee and had them do an on-site visit to customize and integrate the new center and equipment. Okay? So these are not going to be ancillary services, okay? And they're not going to be determined to be de minimis either. So ancillary and de minimis, what do those mean? They mean they've occurred only once or very, very rarely and are immaterial, okay? So does Mark Corporation have Arizona income tax liability? And the answer is yes. All right, so economic nexus. All right, this is what I was referring to. It used to be that physical nexus was the gold standard and was what, quite frankly, businesses were trying to avoid if they were trying to limit their state income tax exposure. Now there is this concept of economic nexus, okay? So with this economic nexus, what does that mean? That means even without a physical presence, you may have income tax nexus if it has an economic presence in the state, okay? And there's this MTC factor that states are trying to propagate. All right, two basic ways that corporations can function. They can function filing separate tax returns. So only businesses with nexus in a state have to file an income tax return, or they can be a unitary tax return state, okay? So they can become a unitary group, which means all members meeting this criteria file whether they have nexus or not. And then, so states west of the Mississippi and the great state of Illinois are all unitary return states. So that includes Missouri. All right, so how do you determine whether a group of businesses is unitary? Well, the Supreme Court has identified these three factors, okay? And so essentially what happens then is businesses must calculate their state taxable income for each state in which they file tax returns. And the federal taxable income is typically the starting point for that. And then the businesses must reconcile from federal taxable income to state taxable income. Okay, and they have to identify these federal to state adjustments before apportioning the income to a particular state. Okay, so an example of a very common adjustment is interest income, right? Because states don't tax federal interest income. All of your states are going to require a negative adjustment for federal interest income. Okay, and then here is a pretty good list of some common adjustments. All right, and as we've already talked, you have to divide your income among states. All right, and so let's get kind of into the nuts and bolts of that. All right, so let's talk about apportionment formulas. All right, and so how does apportionment work? Well, most states rely on three factors: sales, payroll, property. Okay, and then this would be how your sales factor would be determined. All right, so business income includes all revenues earned in the ordinary course of business, less sales, cost of goods, and other expenses. Okay, they're divided across the states where nexus exists, and interestingly, businesses can apportion if it has nexus in the state, even if that state does not actually impose a tax. And so that might be very advantageous to states because, say, for example, one of the states that you have nexus in is Florida, and say Florida did not have a corporate income tax. Well, if that were the case, you would want to fairly apportion your Florida-related business income to Florida, right? And get it out of other states that did have a corporate income tax. Or, obviously, not all states have the same corporate income tax rate, okay? All right, so here's another slide about the sales factor, okay? And then you've got the general rule for determining the amount of sales to include in the sales factor. Now, if a business does not have nexus in the destination state, sales are generally thrown back to the state from which the property is shipped. So that's called the throwback rule, okay? So, for example, sales picked up by the customer, these are called dock sales. They're generally sourced in the destination state rather than the state where they were picked up, okay? For example, if you, Illinois and Missouri are great examples because, you know, we just cross the river and we go back and forth, right? So if I were to go and pick up, right, items from Missouri, they are sourced to Missouri rather than, they are sourced in the destination state, Illinois, rather than where they would be picked up, okay? Now, sales of services are a little bit different. Sales of services are sourced to the state where the services are performed, except, of course, California and Illinois are notable exceptions to that rule. Okay. Payroll. Obviously, there are payroll implications. Okay, and so we've got our definition of payroll. Total compensation includes salaries, commissions, does not include amounts paid to independent contractors, okay? And then payroll for each employee is apportioned to a single state, all right? So each employee is essentially it defines which state each employee essentially is apportioned to, okay? And then we've got what is included in property, All right, so there are a couple of interesting things about property. Okay, so for property, you need to use the average property values for the year. So if there's a significant change in property across the year, so then that would be beginning plus ending divided by 2. So you need to use average property for the year. Okay. You're valuing property at historical cost, not basis. All right. And then, there's an interesting thing that I should have written on this slide, but I'll put it this way. So rented or leased property. Rented or leased property, you multiply the value that's included in your calculation. You multiply the annual rent by 8. Oops. Okay. You multiply the annual rent by 8, and you add this value to the average owned property factor. So okay, so your average owned property factor is going to equal all of your owned property plus 8 times whatever your annual rent amount is for any rented or leased property. All right, so there are some common types of non-business income, okay? And so it's important to understand how to allocate these things. So royalties, right, get allocated to the state where the property is used, okay, if the business has nexus in that state. If not, then you allocate royalties to the state of commercial domicile, all right? So that's kind of important, right? Capital gains from investment property are allocated to the state of commercial domicile, and capital gains from selling rental property capital gains are allocated, to the state where the property was located, okay? So that's an important differentiation between capital gains. All right, state income tax liability. So what constitutes state state taxable income is business income times your apportionment factor plus your non-business income that's allocated to the state. All right, this right here is where I see folks forget things typically. All right, so again, pay attention to capital gains, interest, and royalties for those types of items. All right, what about non-income based states? All right, so then you just have to worry about physical presence, okay? All right, so non-income based taxes. Several states have non-income based taxes, all right? Texas, Washington, all right? So they are deductible for calculating taxable income for net income based taxes, all right? And remember that public law that protected some businesses before, it doesn't apply to nexus for non-income based taxes, such as gross receipts taxes or net worth taxes, okay? And that concludes our discussion of Chapter 12. Yay, last chapter.